Hello viewers, welcome to yet another important episode on fundamentals of accounting and financial management. In this episode, you will understand the objectives of financial management, functions and roles of finance managers. For the convenience in understanding these aspects, this episode is divided into 5 subheadings, namely objectives of financial management, is wealth maximization model superior to profit maximization, finance decisions, functions of finance management or finance functions, role of a financial manager. Let us start with the objectives of financial management. Financial management is concerned with the procurement and judicious use of funds. Its main aim is to maximize the earnings and the value of the equity share in the best interest of the business enterprise. As we know, each and every management should have some goal or objective of its own to achieve. In the context of that objective, the managers make decisions. Similarly, financial management decisions are also based on certain goals or objectives. The goals are maybe to maximize the sales revenue, net profit, return on investment, size of the firm, percentage of market share, etc. Financial management provides a framework for selecting a proper course of action to achieve these goals. However, the main objective of a firm is to maximize the owner's economic welfare. The main objective can be achieved through profit maximization and wealth maximization. Profit maximization. As a basic principle, any business activity aims at earning profits. According to this principle, all functions of a business will have profit as the main objective. No business can survive long without earning profit. Similarly, finance functions will also have profit as the main objective. This principle of profit maximization is a traditional belief. This objective is based on the efficiency of an enterprise. Profits also serve as a protection against contingencies. The accumulated profits enables a business to face risks like fall in prices, competition from other units, adverse government policies, etc. Thus, profit maximization is considered as the main objective of business. There are several arguments in favor of profit maximization as the objective of a business. They are: number 1, when profit earning is the aim of the business, then profit maximization should be the obvious objective. Number 2, profitability is a barometer to measure efficiency and economic prosperity of the business firm. Number 3, economic and business conditions do not remain same at all the times. A business will be able to survive under unfavorable conditions only when it has some past earnings to rely upon. So, a business should earn more and more when the situations are favorable. Number 4, increased profits lead to growth and development, and hence companies must aim to maximize the profits. Number 5, profitability is essential for fulfilling the social goals too. A firm, by pursuing the objectives of the profit maximization, also maximizes socio-economic welfare. Though there are other arguments in favor of profit maximization criteria, there are arguments which are against this objective. The objective of profit maximization was criticized on the following grounds. Number 1, ambiguity. The term profit itself is vague and cannot be precisely defined. It means different things for different individuals. Again, ambiguity arises when we consider the profit either to be a short-term profit or long-term profit, whether to consider profit before tax or after tax, whether it is the operating profit or earnings available for shareholders, and so on. Number 2. Time factor. The objective of profit maximization was developed when the attitude of the business was different. The business was self-financed and self-controlled, but today most of the business organizations witness divergence between ownership and management. Further, most of the businesses are run on borrowed funds with only a small fraction of owners' capital. Thus, profit maximization will only act as a narrow objective. Number 3. Risk factor. Profits always go hand in hand with risks. The most profitable ventures necessarily involve more amount of risk. The owners of business will not like to earn more and more profits by accepting more risk. If the profit maximization is accepted as the objective of finance function, it totally ignores the risk factor. Number 4. Time value of money. Profit maximization objective ignores the time value of money and does not consider the magnitude and timing of earnings. It treats all earnings as equal, though they occur in different periods. It ignores the fact that cash received today is more important than the same amount of cash received after the lapse of time, let us say 1 year. 5. Social consideration. Profit maximization as a financial management objective does not take into consideration the social aspects as well as the obligations to various interests of workers, consumers, society, etc., and the ethical business practices. If these factors are ignored, the organization cannot survive in the long run. With a view to eliminate some of the above shortcomings of profit maximization objective, modern thinkers of financial management proposed that the wealth maximization should be preferred over the profit maximization. Wealth maximization. Wealth maximization simply means maximization of shareholders' wealth. It is combination of two words, namely wealth and maximization. Wealth of a shareholder maximizes when the net worth of a company maximizes. Wealth maximization is also known as the net present worth maximization. It means maximizing the net present value of any course of action. The net present value can be calculated as the difference between the present value of cash inflows of any course of action exceeds the present value of cash outflows. The difference adds on to the net wealth of the firm and thus wealth of the firm increases. The pursuance of shareholder wealth maximization as an objective removes the technical limitations of profit maximization. Shareholder wealth is the market value of the firm's equity shares. Shareholder wealth is calculated as the number of common shares outstanding times the market price per share. The goal of shareholder wealth maximization is a long-term goal and takes risk into account. In order to increase shareholders' wealth, companies invest in long-term projects, highly profitable ventures. To be even more meticulous, a shareholder holds shares in the company or the business and his wealth will improve if the share price in the market increases, which in turn is a function of net worth. This is because wealth maximization is also known as net worth maximization. Finance managers are the agents of shareholders and their job is to look after the interest of the shareholders. Wealth maximization model is said to be a superior model because it eliminates almost all the drawbacks of profit maximization as a goal to finance decisions. Some of the important points which victors over the profit maximization objectives are discussed below. First of all, the wealth maximization is based on cash flows and not on profits. Unlike the profits, cash flows are exact and definite and therefore any ambiguity associated with accounting profits can be easily avoided. Secondly, profit maximization presents a short-term view as compared to wealth maximization. Short-term profit maximization can be achieved by the managers at the cost of long-term sustainability of the business. Thirdly, wealth maximization considers the time value of money. It is important, as we all know, that a rupee today may or will not have the same value as a rupee 1 year later. In wealth maximization, the future cash flows are discounted at an appropriate discounted rate to represent their present value. Fourthly, the wealth maximization criteria consider the risk and uncertainty factor while considering the discounting rate. The discounting rate reflects both time and risk. Higher the uncertainty, the discounting rate higher, and vice versa. In summary, the wealth maximization as an objective to financial management and other business decisions enables the shareholders to achieve their objectives and therefore is superior to profit maximization. For financial managers, it is a decision criterion being used for all the decisions. The main objective of financial management is to arrange sufficient finance for meeting short-term and long-term financial needs. Several decisions have to be made for the arranging the finance and its proper allocation. In all the following financial areas of decision making, the role of finance manager is vital. We can classify the finance functions or financial decisions into four major groups. Number 1, investment decision. Number 2, financing decision. Number 3, dividend decision. Number 4, present earnings versus future earnings. Number 1, investment decision. Investment decisions are the most important decisions made by finance managers. These decisions are concerned with selecting right type of assets in which funds will be invested by the firm. The assets which can be acquired fall into two categories. A, long-term assets. Long-term assets are those which yield a return over a period of time. In future, these are the assets which generate revenue. B, short-term or current assets. These are the assets which are in normal course of business operations, convertible into cash usually within a year. The first category assets are popularly known as the capital budgeting, and the second category are known as the working capital management. We will be discussing about them in detail in the coming episodes. Number 2, financing decisions. Financial manager has to make a decision regarding raising of funds, that is, he has to decide the source mix or capital structure or leverage. Broadly speaking, he has to decide how to acquire funds to meet the investment needs. The central issue before him is to decide how to acquire the needed funds, how much must be owned capital and how much must be the borrowed money. The mix of debt and the equity is known as capital structure. For his firm, the firm's capital structure is considered optimum when the market value of the share is maximum. A proper balance between debt and equity to ensure a trade-off between risk and return is necessary. Financing decisions involve capital structure decisions along with its theory. Number 3, dividend decisions. It is a third major financial decision where finance managers should decide on problems such as declaration and payment of dividends. He has to decide whether the firm should distribute all profits or retain all profits, or one portion distributed and a portion of profit is to be retained. The proportion of the profit distributed as dividends is called dividend payout ratio, and a retained portion is called retention ratio. The dividend can be declared from the current profits or accumulated profits, and the retained profits may be utilized for further investments. In this sense, dividend decisions becomes a part of financing decision as well as part of investment decision. Ultimately, the final decision will depend on the preference of shareholders and investment opportunities available within the enterprise. If adequate profitable investment opportunities are available within the enterprise, profits are to be retained because return to the shareholders would be maximum and price of share would also rise. If the enterprise does not have an investment opportunity, the profits should be distributed as dividends to shareholders who in turn may invest their dividends amount in better outlets. Number 4. Present earnings versus future earnings. If all the profits are distributed in the form of dividends, the shareholders will be happy and the market value per share will increase, but no funds are left for expansion and future growth is restricted. If the entire profit is retained, there will be enough funds for the growth, but current share value will come down in the market. Optimum dividends policy is one that maximizes the market value of the firm's share. Therefore, a finance manager has to strike a balance between the present earnings and the future earnings. Number 1. Estimation of capital requirements. A finance manager has to make estimation with regards to capital requirements of the company. This will depend upon expected costs and profits and future programs and policies of the concern. Estimations have to be made in an adequate manner which increases earning capacity of enterprise. Number 2. Determination of capital structure. Once the estimation of capital requirement has been made, the capital structure have to be decided. This involves short-term and long-term debt equity analysis. This will depend upon the proportion of equity capital a company is possessing and an additional funds which have to be raised from outside parties either by way of additional issues of equity shares or through debt capital. Number 3. Choice of source of funds. For additional funds to be procured, a company has many choices like issue of shares and debentures, loans to be taken from banks and other financial institutions, public deposits to be drawn like in the form of bonds. Number 4. Investment of funds. The finance manager has to decide to allocate funds into most profitable ventures so that there is safety on investment and regular returns can be availed. Number 5. Disposal of surplus. The finance manager must also determine the treatment of net profit. This treatment can be done in two ways. A. Dividend declaration. It includes identifying the rate of dividends payable and other benefits such as bonus shares, etc. B. Retained profit. The volume of the profit to be retained has to be decided, which will depend upon future expansion, innovation and diversification plans of the company. Number 6. Management of cash. The finance manager has to make decisions with regards to cash management. Cash is required for many purposes like payment of wages and salaries, payment of electricity and water bills, payment to creditors, meeting current liabilities, maintenance of enough stock, purchase of raw materials, etc. Number 7. Financial controls. The finance manager has not only to plan, procure and utilize the funds, but he also has to exercise control over finances. This can be done through many techniques like ratio analysis, financial forecasting, cost and profit control, etc. A financial manager is a person who takes care of all the important financial functions of an organization. The person in charge should maintain a far-sightedness in order to ensure that the funds are utilized in the most efficient manner. His actions directly affect the profitability, growth and goodwill of the firm. Following are the main roles of a financial manager. Number 1. Raising of funds. In order to meet the obligations of the business, it is important to have enough cash and liquidity. A firm can raise funds by the way of equity and debt. It is the responsibility of a financial manager to decide the ratio between debt and equity. It is important to maintain a good balance between equity and debt. Number 2. Allocation of funds. Once the funds are raised through different channels, the next important function is to allocate the funds. The funds should be allocated in such a manner that they are optimally used. In order to allocate funds in the best possible manner, the following points must be considered. A. The size of the firm and its growth capability. B. Status of assets, whether they are long term or short term. C. Mode by which the funds are raised. These financial decisions directly and indirectly influence other managerial activities. Hence, formation of a good asset mix and proper allocation of funds is one of the most important activity. Number 3. Profit planning. Profit earning is one of the prime functions of any business organization. Profit earning is important for survival and sustenance of any organization. Profit planning refers to proper usage of profit generated by the firm. Profit arises due to many factors such as pricing, industry competition, state of the economy, mechanism of demand and supply, cost and output. A healthy mix of variable and fixed factors of production can lead to an increase in the profitability of the firm. Fixed costs are incurred by the use of fixed factors of production such as land and building, machinery, etc. In order to maintain a tandem, it is important to continuously value the depreciation cost of fixed cost of production. An opportunity cost must be calculated in order to replace those factors of production which has gone through wear and tear. If this is not noted, then these fixed costs can cause huge fluctuations in profits. Number 4. Understanding capital markets. Shares of a company are traded on stock exchange and there is a continuous sale and purchase of securities. Hence, a clear understanding of capital market is an important function of a financial manager. When securities are traded on stock market, there involves a huge amount of risk. Therefore, a financial manager understands and calculates the risk involved in this trading of shares and debentures. It is on the discretion of a financial manager as to how to distribute the profits. Many investors do not like the firm to distribute the profit amongst the shareholders as dividends, instead invest in the business itself to enhance the growth. The practices of a financial manager directly impact on the operations in the capital market. To sum up, there are two basic objectives of financial management, namely profit maximization and wealth maximization. Profit maximization objective is said to be a traditional belief which aims at making and maximizing profits for the economic prosperity of an enterprise. However, this objective was criticized on the basis of some important reasons. On the other hand, the objective of wealth maximization is said to be a broader and modern belief which aims at the maximizing the value of the shares. Financial decisions are the decisions to be made for arranging the finance, and its proper utilization includes investment decisions, financing decisions, dividend decisions and present earnings versus the future earnings. The functions of finance includes estimation of capital requirements, determination of capital structure, choice of source of funds, investment of funds, disposal of surplus, management of cash and financial control. Financial managers have to play a vital role in carrying out the functions of finance in an organization. These roles include raising of funds, allocation of funds, profit planning, and understanding the capital markets.